As a real estate investor, navigating the complex world of taxes can feel overwhelming. However, understanding how to legally minimize your tax liabilities is crucial for maximizing your profits. In this video, we'll explore various tax strategies available to real estate investors that can help you keep more of your hard-earned money in your pocket. One of the most effective strategies is taking advantage of deductions. From mortgage interest and property taxes to depreciation and repair costs, these deductions can significantly reduce your taxable income. Additionally, utilizing tax-deferred exchanges, such as a 1031 exchange, allows you to defer capital gains taxes when reinvesting in new properties. Understanding tax laws is not just about compliance, it's about leveraging them to your advantage. By familiarizing yourself with the latest tax regulations, you can identify opportunities that may have otherwise gone unnoticed. This knowledge empowers you to make informed decisions that can lead to substantial savings. Imagine the potential benefits of strategic tax planning: lower tax bills, increased cash flow, and the ability to reinvest those savings into your real estate portfolio. By engaging in proactive tax strategies, you can enhance your financial position and achieve your investment goals more effectively. So, stick around as we dive deeper into these strategies and help you unlock the full potential of your real estate investments. As a real estate investor, one of the most powerful tools at your disposal is the ability to take advantage of various tax deductions. These deductions can significantly reduce your taxable income, allowing you to keep more of your profits. Let's discuss some of the most common deductions available to you. First up is mortgage interest. If you have a loan on your investment property, the interest you pay is typically deductible. This can lead to substantial savings, especially in the early years of your mortgage when interest payments are at their highest. Next, property taxes are another major deduction. The taxes you pay on your investment properties can be deducted from your taxable income, further lowering your tax liability. Repairs and maintenance costs are also deductible. Whether it's fixing a leaky faucet or repainting a room, these expenses can add up, and deducting them can provide significant tax relief. However, to fully benefit from these deductions, it's crucial to keep accurate records of all your expenses. Detailed documentation will not only help you during tax season, but also protect you in case of an audit. Depreciation is a powerful tax strategy that can significantly reduce taxable income for real estate investors. At its core, depreciation is the process of allocating the cost of a tangible asset over its useful life. For rental properties, this means that you can deduct a portion of the property's value each year as it ages. This deduction helps offset your rental income, ultimately lowering your tax liability. For example, let's say you purchase a rental property for $300,000. If the land value is assessed at $100,000, you can depreciate the remaining $200,000 over 27.5 years, which is the standard depreciation period for residential rental properties. This results in an annual deduction of approximately $7,273. If your rental income for the year is $30,000, this depreciation can effectively reduce your taxable income to $22,727, providing significant tax savings. Understanding the different methods of depreciation is crucial for maximizing your benefits. The most common method is the straight-line depreciation, where the same amount is deducted each year. However, there are also accelerated methods, like the Modified Accelerated Cost Recovery System, MACRS, which can provide larger deductions in the earlier years of ownership. By grasping how depreciation works and the various methods available, you can strategically plan your investments and optimize your tax situation. This knowledge not only enhances your cash flow, but also contributes to your overall investment success. You also want to leverage a strategy known as the 1031 exchange, which allows real estate investors to defer taxes on property sales, enabling them to reinvest their profits without immediate tax liabilities. Named after Section 1031 of the Internal Revenue Code, this strategy can be a game changer for those looking to grow their investment portfolios. To qualify for a 1031 exchange, there are specific requirements that must be met. First, the properties involved must be like kind, meaning they must be of the same nature or character, although they don't have to be identical. Additionally, the investor must identify a replacement property within 45 days of selling the original property and complete the purchase within 180 days. The benefits of a 1031 exchange are substantial. For instance, if you sell a rental property for $500,000 and make a profit of $200,000, instead of paying capital gains taxes on that profit, you can reinvest the entire $500,000 into a new property. This allows you to leverage your investment and potentially acquire a more valuable asset, all while deferring tax payments. By utilizing the 1031 exchange strategy, investors can significantly enhance their long-term investment growth. It not only helps in building wealth, but also provides the flexibility to adapt to changing market conditions. If you're serious about maximizing your real estate investments, exploring the 1031 exchange could be a crucial step in your financial journey. Investing in real estate investment trusts, or REITs, can offer significant tax advantages for investors looking to diversify their portfolios. A REIT is a company that owns, operates, or finances income-producing real estate across various property sectors. By pooling funds from multiple investors, REITs allow individuals to invest in large-scale real estate projects without the need to directly purchase or manage properties. One of the key tax benefits of REITs is their unique structure. To qualify as a REIT, a company must distribute at least 90% of its taxable income to shareholders in the form of dividends. This requirement means that REITs typically do not pay corporate income tax, allowing investors to benefit from a more favorable tax treatment on their earnings. As a result, the income generated from REITs can be more tax efficient compared to traditional investments. Additionally, investing in REITs provides the advantage of passive income. Investors can earn regular dividend payments without the responsibilities of property management. This makes REITs an attractive option for those seeking a steady income stream. Furthermore, REITs offer diversification, as they invest in a variety of properties, from residential to commercial, reducing the risk associated with investing in a single property. If you're looking to enhance your investment strategy, consider incorporating REITs into your portfolio. They not only provide tax advantages, but also offer a way to access the real estate market with less capital and effort. Tax credits can be a valuable resource for real estate investors looking to reduce their tax liabilities. Unlike deductions, which lower your taxable income, tax credits directly reduce the amount of tax you owe, making them particularly beneficial. One notable example is the Low-Income Housing Tax Credit, LIHTC, designed to encourage the development of affordable rental housing. This program provides tax credits to investors who build or rehabilitate rental properties for low-income tenants, allowing them to claim a dollar-for-dollar reduction in their federal tax liability. The LIHTC can significantly impact an investor's financial situation. For instance, if you invest in a qualifying property and receive a tax credit of $10,000, that amount is deducted directly from your tax bill, providing substantial savings. This incentive not only helps investors, but also addresses the critical need for affordable housing. In addition to the LIHTC, there are other tax credits available, such as the Rehabilitation Tax Credit for restoring historic properties and energy efficiency credits for making improvements that reduce energy consumption. It's essential for investors to research the various tax credits available in their area, as these programs can vary by state and locality. By understanding and utilizing these credits, you can enhance your investment strategy and maximize your tax savings. So, take the time to explore the options available to you and see how they can benefit your real estate investments. Understanding tax deductions, depreciation, and credits is crucial for maximizing your profits and minimizing your tax liabilities. Deductions like mortgage interest, property taxes, and repair costs can lower your taxable income, while depreciation allows you to deduct the cost of your property over time, providing substantial savings. Various tax credits, such as the Low-Income Housing Tax Credit, can directly reduce the amount of tax you owe. Taking advantage of these strategies can lead to enhanced cash flow and long-term investment growth. However, navigating the complexities of tax laws can be challenging. That's why we encourage you to consult with a tax professional who can provide personalized advice tailored to your specific situation. They can help you identify opportunities and ensure you're compliant with all regulations. If you found this information valuable, please consider subscribing to our channel for more insights on real estate investing and tax strategies. Don't forget to like this video and share it with fellow investors who could benefit from these tips. Together, we can build a community of informed investors ready to take their real estate ventures to the next level. Thank you for watching, and we look forward to seeing you in our next video.